You're welcome to today's lesson. In today's lesson, we are going to be looking at one very important topic in accounting. But before we do that, I want to use this opportunity to encourage students. If you are preparing for any exam that is accounting related, please, I encourage that you create time to listen to this video or look at this video and then give it undivided attention. There is need for you to really understand the content of this lesson so you'll be able to answer the questions that you will possibly come across in your exams. There is no exam that is written in accounting where the examiner will not want to test one or two questions on the subject matter partnership. And then I also want to mention that students shouldn't forget to always go to the exam guide to solve as many questions as possible. It is very, very important. All right, having said that, let's look at what we have. I said the topic we are going to discuss is partnership account. But before we look at the topic, let's look at what we serve as our compass, what I call the Google map of our lessons. Every lesson must have a target, it must have a direction, it must have a goal. It is this goal or this target or this focus that will now moderate our interaction, moderate our focus in the lesson. And then we call it objectives, lesson objective. Now in our today's lesson objective, we have just few points we are going to look into. Number one, we are going to define partnership. We want to understand what partnership is all about. If you are asked, what is partnership? You should be able to define partnership without stress. The second thing that we're going to explain partnership deeds and its content. What do you understand by the term partnership deed? And what are those elements? What are those components? Or what are those contents that can be found in a partnership deed? The third objective, we are going to describe the types of partners. Not everybody that belongs to a partnership business are actually partners. We have just few categories or few types or few classification or few divisions of persons that can form in the partnership business. We are going to look at that under the types of partners. And then we mention the required account for partnership business. Not every account is prepared for partnership business. We have selected accounts that are very, very important in the preparation of partnership business. If you don't understand these various accounts, you won't be able to prepare them. And then the last but not the least, we will answer related questions from our exam guide. All right, having looked at our objective, let's quickly define partnership. What is partnership? According to Section 1 of the Partnership Act, 1890, partnership can be defined as a relationship which subsists between persons carrying on a business in common with a view of profits. What does that mean? It is a relationship which subsists between persons carrying on a business in common with a view of profit. Now, let me explain the term relationship, because I know that the society is governed by relationship. One person must be related to another. They can be related by birth, they can be related by work, they can be related by maybe by vocation. Different things can bring people together to form a relationship. But there is need for students to understand or to differentiate a business relationship from an ordinary relationship. And not just business relationship, a business relationship that can be called partnership. And that's what we want to explain in this definition. We say relationship which subsists between persons carrying on a business in common with a view of profit. That means that if that relationship is qualified to be a partnership relationship or partnership business, such a relationship must have profit in view. It must not be something that is done or two persons coming together for emotion. One person can fall in love with another person and they form a relationship. Some other times too, three siblings can come together to own a property. When this happens, we call it co-ownership. These are various dimensions and ways relationship can actually be formed. We cannot exhaustively explain different angles and dimensions of relationship. But for the sake of this lesson, we want to explain that if it is qualified, or if it must qualify as a partnership business, then the relationship must be profit-driven. It must be profit-centered. It must be profit-sensitive. If these persons who are in a relationship are not profit-sensitive, are not profit-centered, are not profit-driven, then it is not a partnership business. Now, I said it can be formed by 2 to 20 persons. It's something that must start from 2. The minimum is 2 persons and the maximum is 20. This is likely an examination question. They will ask you that which of the following business must, or in partnership business, the minimum number of persons to form a partnership business is dash. The minimum number of persons to form a partnership business is dash. They can say A, 3 persons, B, 2 persons, C, 5 persons, D, 7 persons. Now, I have stated here that the minimum number of persons to start up a partnership business is 2. So the answer is always 2. So B is actually the answer. So wherever you are or however you are looking at it, 2 persons are the minimum persons to start up a partnership business, and the maximum is 20. Once it is 21, 22, down to 50, it becomes a company. All right, let's quickly look at what partnership deed is all about. When we talk about partnership, first of all, we have said it has to do with business relationship. Now, this relationship must come with certain rules and regulations. If rules and regulations are not there to guide behaviors, are not there to guide attitude, are not there to guide actions, then you will see that there must be a clash of attitude or clash of actions, or one person will want to encroach into another person. So there is a need to come up with, what we call rules and regulations that will guide the totality of the business. So a partnership deed is actually a legal document that serves as the foundation of partnership firm, defining the terms of the partnership agreement among its members. It must be a legal document. What I mean by legal document is that it must be backed up by law. It's not something that is formed out of emotion. You say, okay, let us do. No, it must be something, the document or the rules and regulations must be recognized by the law. Remember, when we are defining it, we look at the Partnership Act of 1890. So whatever that is happening or whatever that is coming up as the rules and regulations must be legal. That is why we said it is a legal document, and it must define the terms of the partnership agreement among its members. The sole aim of the partnership deed is to give a clear definition of the terms of agreement. Another thing is that it is also a comprehensive document that outlines various aspects of the partnership. It includes the roles, responsibilities, and the rights and obligations of each partner. The roles, the responsibilities, the rights, and the obligation. Every partner should understand what his or her role is, then understand his or her own responsibility, and then the rights, what he or she stands to benefit from the business, and the obligation, the duty that he or she is expected to carry out for the business. It is also known as partnership agreement, articles of partnership, or partnership contract. Now, I just want to emphasize here that different authors will want to use different terminologies to describe what partnership deed is. So whenever you come across partnership deed, you can also see it in some other texts as partnership agreement, articles of partnership, or partnership contract. So whether the author decides to use partnership deed, partnership agreement, articles of partnership, or partnership contract, what the author is actually saying is referring to partnership deed. Now, let's quickly look at the accounting requirement of a partnership deed when there is a written agreement. We have said that we are going to define what a partnership deed is, and then we will look at the content. So there are two basic scenarios where a partnership document can actually be formed, or where the partnership deed can actually be formed. Number one is when there is a written agreement. Two or three persons can come together and say, we want to write out or spell out the rules and regulations that must protect and guide this partnership business. So when this is done, there is an accounting requirement. Remember that this partnership can actually be viewed from different pillars of studies. You know, if you take it out of accounting, if you take it to economics, it may be seen as a different thing. You take it to commerce, it may be seen as it. So we are looking at partnership from the angle of accounting. Looking at partnership from the angle of account. That is why we are actually, focusing on the accounting requirement. What are the requirements for partnership deed? What are the accounting requirements for partnership deed when there is a written agreement? Number one, the capital to be contributed by each partner. Every partnership deed, as long as there is a written agreement binding the partners, must spell out the capital that must be contributed by each partner. What are we saying? We are three, want to form a partnership business. How much are we supposed or expected to bring? That partnership deed must spell out. You bring this, you bring that, you bring this. It must spell out the capital contributed by, so that if tomorrow something happens, by the time we go back to our partnership deed will be able to remind us that this is the amount of capital that is expected to be introduced by partners. Very important. Number two, the rate of interest on capital. The partnership deed must also spell out the rate of interest. What do I mean by interest? Interest is very, very important because it encourages the partners to bring more capital. Somebody that is introducing 5 million into a business and somebody that is introducing 2 million into a business, they are not expected to have the same benefits. So you that is bringing 5 million, this person that is bringing 2 million, if we have agreed that the interest that will be given or accruable to partners is 5%, you calculate 5% of 5 million, and then this person calculates 5% of 2 million. You can see now that it cannot be of the same level. So at this point, the interest must be spelled out in the partnership deed. Whenever the interest is spelled out in the partnership deed, nobody will come tomorrow and say, I'm not satisfied with the interest that is given to me on my capital. Or partner A will say, I'm not satisfied. As long as it is spelled out, everybody will actually be satisfied. The third one is that the rate of interest on drawing. The rate of interest on drawing. The interest that will be charged on drawing must also be spelled out. Drawing is simply when cash or goods are taken from the business for personal use. Some partners may want to cash out for personal use. We are doing a business and maybe something very important or urgent happened in the family of one of the partners. And the partner needs cash. He may want to take the cash from the business. So for every time a partner is taking money from the business for personal use, when that money is not being used to promote the business, that money that is taken out of the business for personal use is called drawings. So there must be an interest. If interests are not placed on this money, you see, to discourage partners from taking money from the business, tomorrow Peterson will want to withdraw, next tomorrow John will want to take, the next day Betty will want to take. Before you know now, just personal challenges and personal interest can even make the business to run out of cash. So to reduce or to discourage these tendencies, there is need to come up with interest rate. So this interest rate must be spelled out in the partnership deed. The next one is the division of profit or losses. How do we intend to share our profit? Should we share our profit equally? Is there a particular ratios we can actually share our profit? Is it 2:1:3, or is it 1:2:3, or is it 3:2:1? Partners will also agree on their profit or loss sharing ratios. And the second to the last is that partners' salary, commissions, and other remunerations, it must be spelled out, because some partners are actually very active than others. So how do we compensate the commitment of an active partner? How do we compensate the dedication of a partner that is involved in the day-to-day running of the business? The salary that needs to be paid, the commissions that need to be given, and the remunerations that need to be given. All of these are motivational packages that must be given to the active partner, and it must be spelled out in the partnership deed. If this is not done, then it becomes very, very difficult, because if this is not done, you will see that some persons can be demotivated, haven't committed time, haven't committed resources. You see, you come back at the end of the day, it's as if this person is not appreciating your commitment. Some partners can just present something, maybe resources or maybe money, and then they will just go about their personal business. They won't even care about the partnership business. But there are some people that are there, in the morning, in the afternoon, and in the night. This set of persons need to be encouraged. We'll come back to that as we make progress in the lesson. And the last but not the least, the basis of valuing goodwill on the death or retirement of a partner. Partnership business is a business that is expected to live forever, following the going concern concept of accounting. No business will want to start and end in soonest. Every business wants to survive forever. But there are occasions, there are things that can actually bring a partnership business to an end, or that there are things that can make the partnership to review their profit sharing ratio, or to review certain activities around the business. And one of those things that need to be reviewed is what we call goodwill. Goodwill is seen in different ways. Goodwill can be seen as a possibility of an existing customer to continue to patronize a particular business even when there is or there are changes in the ownership of the business. Goodwill, from a layman perspective, can be seen as a good name that is created through the credibility of a business. If a business is doing well, the society recognizes a particular business that is doing well, society will always want to look out for such a business. So when there is a change in the ownership of that business, society may not know, because management are the engine behind every successful business. And most times, these persons may not even be seen. They may not be seen. They might just be working in the background. So if the ownership of a business has changed and the name is still there, that name that the customers are still coming, the customers still want to patronize it because of a particular name. I wouldn't want to mention a brand. I would have mentioned a particular brand and then begin to explain how there have been some changes in the management of the particular brand, yet customers are still patronizing the business. So when there is need to review the goodwill, then it must be spelled out in the partnership deed. I said the basis of valuing goodwill on the death of or retirement of a partner. So if a partner decides to die, or a partner eventually died, that particular partner that died, the death of a partner can bring the partnership business to an end. So what is going to happen is that, as at that time, maybe one person, the existing partner, may want to bring in another person. They may want to admit a new partner. So a new partner that is admitted into the business cannot just come to the business and begin to enjoy the hard work of the existing partners. They may have to now review goodwill. Now, the simple question is, what this thing we call goodwill, how do we measure our goodwill in monetary terms so that it can be shared? How do we measure our goodwill? We have been in existence for 20 years, and we are saying that goodwill from the perspective of a layman is simply the reputation or the good name that has been created by the business through their credibility. So how do we measure goodwill? In this case, goodwill is simple. The difference between purchase consideration and your net asset. What you are going to do is to value all the assets of the business. Value them. You know, let's assume that the worth of the business is about, let me assume it's 5 million. That's the worth of the business. So at what price can this business be sold out? If I want to sell this business, how much will I be able to sell it? If I can sell the business for 10 million and the worth of the business is 5 million, the difference between what I can sell the business or what I am ready to sell the business and the worth of the business become the goodwill. So if 10 million is the amount of money that I can actually sell this business, while the net worth of our asset is 5 million, then your goodwill is 5 million. So that difference between your purchase consideration and your net asset becomes your goodwill. So it must be stated in your partnership deed how this goodwill can be valued. All right, let's look at when there is no written agreement. Well, now we have looked at those requirements, those things that are, those accounting requirements, those things that are required where we have written agreement between partners. So the question is, what if we don't have any, there is no written agreement? What will now be the content of our partnership deed? Number one, there will be no interest on capital. Where there are no written agreement, then there will be no interest on capital. Number two, no remuneration or salary. As long as we don't have any legal document that backed up what we are doing, we are not paying salary to anybody. If you like, you are active morning, afternoon, and night. If you like, you are not active, nobody is receiving remuneration. If we are paying salary, the salary will go round. If we are not paying, we are not paying. And then the third one is that profit or losses to be shared equally. If we realize profit, it will be shared equally. Then if we are working at a loss, it will also be shared equally. And then the second to realize that 5% interest a year on loan is 5% interest a year on loan made by partners in excess of the agreed capital. Yes, some partners can be so buoyant, so well-to-do that they can actually borrow the partnership business. They can borrow them money. The partnership business can come to a partner who has originally contributed capital to take loan. So when this loan is taken, if there is no written agreement, then the only percentage that should be charged on loan is 5%. The question is, in this context now, no particular amount is actually mentioned. Why will you say that if somebody is collecting 100,000, 5% should be charged? And if we are collecting 100,000 from a partner as loan, 5% should be charged. And then if we are collecting 5 million, and 5% should be charged. Now, what this means is that it's not as if this 5% is sacrosanct to every amount. What I'm saying here is that this loan is collected in excess of the agreed capital. Now, if this person has already brought the agreed capital and there is need to take extra 5 million, is 5%. 200,000 is 5%. 100,000 is 5%. No matter the amount of money that is taken from that particular partner, it is 5 million. But in a situation where this person's money that has been introduced is not up to the agreed capital, then what is going to happen is that they are going to subtract the agreed capital from the money, and then whatever is left is what the 5% will be charged on. And the last but not the least is that no interest is to be allowed on drawings. Everybody can take from the business. There will be no interest. So, whereas you see that when there is a written agreement, there are interest, must charge interest on drawing. Remember, we mentioned that interest on drawing is there to discourage the frequency of taking from the business. So, when there are no written agreements, then there will be no interest to be allowed on drawing. Okay, let's look at what we call types of partners. We've mentioned that some partners deserve salary. Why they deserve salary, remunerations, and the incentive, why some other partner does not deserve. Now, let's look at the various components or various divisions or classifications of partners in a partnership business. I said not everybody that are involved or not everybody that is involved in a partnership business actually become a partner. A partner must fall within these 4 categories. Number 1, it must either be an active partner. Number 2, a sleeping or dormant partner. Number 3, a nominal partner. And then number 4, a limited partner. We are going to explain these partners one after the other. Let's start with active partner. Who are active partners? These are the partners who take active part in the formation and management of the business. They partake in the day-to-day running of the business. When we talk about active partners, we are talking about partners that are directly involved in the formation, number 1, and the management. Somebody can be an accountant, a lawyer, and maybe a medical doctor can form a business. The 3 of them can become partners. And then the lawyer can decide to introduce just capital. I have 20 million. He can bring his 20 million. Everybody bring 20 million. He can bring his 20 million and decide to travel abroad. And say, please, I don't have the time to stay back and observe the business. As long as the 20 million is contributed, fine. And then the medical doctor can say, okay, me, I'm bringing my 20 million, but I have my private hospital. And my private hospital may not afford me the time to be part of the business, and then decide to focus on his private hospital. Then the accountant says, okay, fine, you have brought your various money. Me, I want to be involved in the management. So the accountant is there. He's the one interfacing with the employees. He's the one, going about the business. If the business is not doing well, he thinks of how to. So this particular person is entitled to what we call salary. And because he is directly involved in the management and in the formation of the business, he is called an active partner. He is active because he did not just introduce capital, but he is also part of the operation of the business. If the business is doing well, it's a function of his technicalities and professionalism. He joined the recruitment process, how to bring in new staff. He also observed the strengths and the weaknesses of staff. He also observed the growth process of the business and stuff like that. So he is an active partner. All right, let's look at the second type of partner, sleeping or dormant partners. The dormant or sleeping partners do not partake in the day-to-day running of the business, but only contribute capital. It's just a typical example of the lawyer and the medical doctor who decide to just bring their money and then and traveled. The lawyer said, I actually have the capital, but I don't have the time. The medical doctor, I have the capital, but I don't have the time. So they traveled. They can just bring in they are called dormant or sleeping partners. The partnership business look at that attitude as a sleeping attitude or a dormant attitude. Because money that you have contributed cannot bring another money. Somebody must use that money and then produce results. So as long as you contributed their money and you are not actively involved in the day-to-day activities of the business, you are a sleeping or a dormant partner. So students should not forget, whenever a partner contributes only capital and that partner is not involved in the day-to-day running of the business, such partner is called a dormant or a sleeping partner. Nominal partners, they only contribute their names to the formation of the business and nothing more. They are normally people of substance in the society. This set of partners, what they do is just to contribute their names. They are people that society respects. Probably they have made names in the business industry. Whenever you hear their names, you know that you've heard about credibility, you've heard about reliability, you heard about transparency. These people are people that society respect. So sometimes business people will want to partner with them. We just want to open a business in your name. And then when you open a business, they are automatically partners. But they are not there. What they do is just to contribute their name. They did not contribute capital nor service. It's just that good name that they've been able to, they've been able to make in the society that can earn them this kind of honor. So that is all about nominal partner. And then the last but not the least is a limited partner. These are partners who are liable to the debt of the partnership business only to the extent of capital they have agreed to contribute. They are not allowed to take part in the management of the partnership business. This kind of partners or this set of partners, they are just liable to the debt of the partnership business only to the extent of their capital they have agreed to contribute. So why they are called limited is because if the business want to fold up, or if the business want to liquidate, the business want to seize, or the business want to collapse, the only thing they are going to lose is their capital. That's the only thing they are going to lose. Unlike general partner, there is a particular partner that is called general partner, where this particular partner, whatever that happens in the business, if it happens that the business collapses, the personal property of the general partner will be brought into the business. But for limited partners, they have nothing to lose. They, apart from the capital they contribute to the business. Say they are not even allowed to take part in the management of the business. Why they are not allowed is because this kind of people, if you allow them to be part of the management, there will be no so much commitment, because they know that if something happens to the business, it's only their capital that is going. They don't have much to lose. That is why this set of partners are not allowed to be part of the day-to-day running of the partnership business. Let's look at the last objective, the required account to be prepared in partnership. I mentioned that we are going to look at the account that are expected to be prepared. Number one, trading profit or loss account, which is also called income statement, appropriation account, where the partnership business shares their profit, current and capital account, and the last but not the least is the balance sheet, which is called the statement of financial position. Now, in course of our lessons, we are going to look at this one after the other. But before we end the lesson, can we take a leave to our exam guide to see if we can just answer one or two questions to further explain what we have discussed so far. We know we are talking about partnership, and this is the introductory part of partnership. So once you do that, you just click on Get Started, and all the questions under the partnership business will just pop up. Question 1, a partner who is liable, a partner who is liable goes beyond his capital. It's supposed to be whose liability goes beyond his capital is known as a general partner. It cannot be limited partner, because we've explained that limited partner is the debt is limited to the capital he contributes. Nominal partner is somebody that contributes only his name. Dormant partner is a partner that is sleeping, contribute only capital. So the answer there is C, general partner. Let's look at question 2. It says, which of the following relates to the essence of partnership? Why do we have partnership business? Remember, we have said that if the relationship is qualified or will be qualified to be called partnership, it must have an objective. And that objective is what? They say A, run a religious objective. No. Form a business for profit. Run a charity organization. Pursue a social objective. Number B. B is the answer. Form a business for a profit. Let's take the last question. We may not be able to take all the questions here, but we will have to just choose maybe 1 or 3. We encourage students to go ahead and check all the 20 questions to be able to see if you have understood the lesson so far. Question 3, a partnership is formed by dash. A, 2 individuals only. B, only 1 individual. C, 2 or more individuals. And then D, 2 or more companies. Now, I have mentioned that partnership is formed by 2 to 20. So if you say 2 individuals only, which is A, you are wrong, because it is more than 2 persons. If you say only 1 person, you are wrong. If you say 2 or more individuals, you are very, very correct, because it cannot be 2 or more companies. So the answer here is C. All right, so that's the much we can take under our exam guide, and we encourage that students continue to go to our exam guide after you have listened to the lesson. We have defined what partnership is all about. We have looked at partnership deeds. We've also looked at the content of partnership deed, when there is a written agreement and when there are no written agreements. And then we've looked at types of partners. We've looked at the accounts that are involved. We encourage that, having listened and looked at this lesson, go back to the exam guide and solve as many questions as possible.